Day. I thank the chair and would yield the floor.
Senator from Iowa.
I would ask permission to speak for about 10 minutes on the Yellen nomination.
Without objection.
Over the past 5 years, the Federal Reserve has pursued unconventional and unprecedented monetary policy. As Vice Chair of the Federal Reserve System, Janet Yellen has been a strong proponent of those policies. As Chair, she's likely to continue these same easy money policies with the same, if not more, vigor than the predecessor. I have deep concerns about the long-term effects of pursuing these policies. Historical evidence suggests that failing to rein in easy money policies on a timely basis risks fueling an economic bubble and even hyperinflation. It is true that one of the lessons learned from the Great Depression of the 30s was that an overly tight monetary policy in a recession risked economic debilitating deflation. Thus, understandably, when the recession hit in 2008, the Fed sought to avoid mistakes of the past by lowering interest rates, encouraging investment. However, this expansionary monetary policy cannot continue into perpetuity without causing real and lasting damage to our economy. Just as we should not repeat the mistakes of the Great Depression, we need to be careful not to repeat the mistakes that fueled our recent recession. Let us not forget that our current economic stagnation began with the bursting of the housing bubble in late 2007, a housing bubble that was fueled by rampant speculation that was driven in part by historically low interest rates maintained by the Federal Reserve between 2001 and 2004. Yet, once again, we see the Fed embarking on a policy of sustained historically low interest rates. The Fed has now maintained that federal funds rate essentially will be at zero over 5 years. What may be the future consequences of this policy? What new bubble will arise? At this point, I don't think anyone can answer these questions definitively. But no one can deny that the risks are real and could be devastating. The Fed, though, has not just sought to maintain record low interest rates. With its traditional monetary tool tapped out, the Fed then has turned to a less conventional and more aggressive program in an attempt to jumpstart our economy and lower unemployment. The Fed is now engaged in an open-ended policy that it has termed quantitative easing. Essentially, this is a fancy way of saying the Fed is flooding the economy with trillions of dollars through large purchases of mortgage-based securities and, even worse, longer-term Treasury securities. As a result of this program, the Fed has seen its balance sheet more than quadruple from around $800 billion to now $4 trillion. Vice Chairman Yellen has not presented a plan to Congress on how the Fed plans to deal with this issue. While I welcome the news from the Fed's December meeting that board intends to reduce its monthly purchases, I fear that they are already way too deep into that purchase of Treasury bonds. It remains unclear how the Fed will be able to go about unwinding its nearly $4 trillion balance sheet without spooking investors. The stock market has become addicted to the Fed's easy money policies. This has led one notable investment advisor to question whether the Fed will ever be able to end the quantitative easing program. While the stock market has become addicted to easy money, the benefit to Main Street has been questionable at best. Unemployment remains high, bank lending remains tight, and savers are discouraged. While the benefits to Main Street remain unnoticeable, they most certainly will feel the pain should the Fed carry on their easy money policy for too long. For an example of what Main Street could be in store for, one needs to only look no further than the late 1970s and the early 1980s. The easy money policies of the 70s, intended to spur employment, resulted in stagflation, a period of hyperinflation as well as high unemployment. During this period, unemployment topped out 10%, while inflation exceeded 14%. The experience of the late 1970s or early 1980s made it clear that once you let the inflation genie out of the bottle, it's very difficult to stamp it out. After suffering years of stagflation, Americans were then subject to the real pain of unprecedented interest rates as high as 20% just to get hyperinflation back under control. Statements by Ms. Yellen indicate that she would be open to inflation exceeding the Fed target of 2% as a means of achieving full employment. While achieving full employment may be a noble goal, the Fed has a dismal record of being able to produce sustainable job creation through expansionary monetary policy. While inflation may aid employment in the very short term, our experiences with stagflation in the 1970s shows this trade-off falls apart quite quickly as people's expectations change. Sustainable job growth comes not from inflation, but price stability that promotes long-term economic growth and the encouragement of investment. We need a chairman focused on a strong dollar and low inflation. My concerns about the Fed's easy money policies and inflation led me to vote against Chairman Bernanke in his second term at the Fed. Because it appears that Ms. Yellen will continue to pursue these misguided policies, I cannot in good conscience vote in favor of her confirmation. I yield the floor. Suggest the absence of a quorum.
Clerk will call the roll.
Mr. Alexander.
Taking a look at the tweets from some members of Congress on this, their first day back from their winter break. And today working on a couple of things. First, a final vote is expected in a few minutes on the confirmation of Federal Reserve Chair nominee Janet Yellen. It's expected at 5:30 Eastern Time. They only need a simple majority to pass that. And then also a second vote scheduled today on moving forward on the unemployment insurance benefits extension. That extension will last for 3 months, and that deals with the unemployment insurance for people who are long-term unemployed. That is set to be held after the Yellen vote.
In business, are we? In business or no?
Madam President.
Senator from Ohio.
Ask unanimous consent to dispense with a quorum.
Without objection.
Thank you, Madam President. For those who don't remember, or those who don't choose to remember, 5 years ago our economy was at the brink of collapse after being rocked by a financial crisis because of incompetence, Wall Street greed, overreach in the financial sector, and more. Washington had let the financial system run wild through deregulation. Banks had overloaded on toxic mortgage securities that they used massive amounts of leverage to purchase. These banks, in many cases, these Wall Street banks were so large, so complex, so opaque, so over-leveraged, they were too big to fail. Increasingly, these banks are too big to manage and too big to regulate. I remember that time well. I was in Zanesville, Ohio, when I first got a call to discuss what we needed to do from Chairman Bernanke and President Bush's Secretary of the Treasury, Paulson. 5 years since the collapse of the market, 3 years after the passage of the Wall Street Reform Law, we still can't say that Dodd-Frank, that legislation, ended this problem. July of last year, Chairman Bernanke said, "I wouldn't be saying the truth if I said that the problem is gone." It's not gone. That's the Chairman of the Federal Reserve. At her nomination hearing before the Senate Banking Committee, Governor Yellen, then the vice chair, now still the vice chair of the Federal Reserve, said too big to fail is, quote, among the most important goals of the, ending too big to fail is, quote, among the most important goals of the post-crisis period. That's one of the many reasons I rise today to support and argue for Janet Yellen's confirmation as the chair of the Federal Reserve. Today's complex financial system, it's more important than ever that we have strong regulators like Governor Yellen who can recognize emerging threats to economic stability and who isn't afraid to act when they find abuses that put American consumers and workers at risk. Throughout her distinguished career at the Fed, more than a decade, Governor Yellen has shown she understands how risky financial practices deep inside the largest Wall Street banks can have a terrible and terrifying impact on American families. She was among 8 or 9 years ago, was among the first to recognize the housing bubble that wiped out trillions in wealth and led to the biggest recession since the Great Depression. In the years since the crash, Governor Yellen has been a voice on the need for strong, sensible regulations that protect American workers and small businesses instead of the too-big-to-fail banks. While there are many failures that led the economy to the brink of collapse, one of the biggest mistakes on the federal level was not keeping the average American's financial interest in mind. There's far too much bias in this institution, Madam President, as you know, far too much bias towards Wall Street instead of Main Street. Most people in my home state of Ohio, in your home state of Hawaii, are not millionaires. They're automakers in Lorain. They're steelworkers in Cleveland. They're farmers in Dark County. They're hairdressers in Toledo. They're police officers in Columbus. They're the people who make the products we depend on every day. My state produces more than any but 2 states in the United States. They're the people who make these products, that teach our children, that protect our communities. They're the average, hardworking Americans trying to create a better life for their children. And they, along with millions of other Americans, deserve better than the crisis that we allowed to happen. Over the years, Washington, the Fed in particular, has too often lacked an important connection to the Americans whose lives are so affected by the decisions it makes. Few have been able to keep a perspective where they understand what's happening in middle America, among working class Americans, among poor Americans, among middle class Americans. When President Lincoln was in office, he would go out and meet regularly with ordinary Americans, either in the White House or outside the White House, while his staff implored him to stay in the White House and win the war and free the slaves and save the Union. President Lincoln said, "I need to go out and get my public opinion bath." We've also seen the new Pope, Francis I, exhort his parish priests to smell like the flock, to get among them, to understand their lives as much as possible, to drink the water they drink, to be among them, to learn from them, and to listen to them. We must know those whom we serve. In a speech last year before the AFL-CIO, Janet Yellen described the real-world implications of unemployment and noted that the unemployed are not just statistics. She took stock of the work ahead of the Fed, for the Fed, notably ensuring that Dodd-Frank is fully implemented in ending too big to fail. I think that she will break out of the Beltway bubble. I think she will get out in the country far more than any of her predecessors have done and consider the lives and work to understand the lives of those people affected by these federal central bank decisions. And as chair of the Fed Subcommittee on Communications, she's played a strong role in monetary policy, its efforts to put people back to work despite Congress's unwillingness, this body's unwillingness to help. Whether it's extending unemployment benefits, which we should be doing today, whether it's raising the minimum wage, it means engaging in the lives and helping people in this country that may not be as privileged as those of us that have the opportunity to serve in the Senate. Janet Yellen is qualified to take the helm of the Fed and make history of becoming the first woman to run the central bank. In confirming her, we can look forward to a new era of recovery and growth. I look forward to working with Janet Yellen and her staff. I urge my colleagues to confirm Janet Yellen to be chair of the Federal Reserve. Madam President, I yield the floor.
Questions on the Yellen nomination? The question is on the Yellen nomination. Is there a sufficient second? There appears to be. The clerk will call the roll.
Mr. Alexander, Ms. Ayotte, Ms. Baldwin, Mr. Barrasso, Mr. Baucus, Mr. Begich, Mr. Bennett, Mr. Blumenthal, Mr. Blunt, Mr. Booker, Mr. Bozeman, Mrs. Boxer, Mr. Brown. Mr. Burr. Ms. Cantwell, Mr. Cardin. Mr. Carper. Mr. Casey. Mr. Chambliss. Mr. Coates. Mr. Coburn. Mr. Cochran. Ms. Collins. Mr. Coons. Mr. Corker. Mr. Cornyn. Mr. Crapo. Mr. Cruz. Mr. Donnelly. Mr. Durbin. Mr. Enzi. Mrs. Feinstein. Mrs. Fisher.
I know you were in Hawaii all the time. I was in Hawaii all the time. I was on the beach yesterday. Yeah. Well, yeah. You know, I had 3 flights canceled yesterday.
Mr. Flake.
Because that day we went from Chicago. I was able to get one direct. But you could get out of the
Mr. Franken. Mrs. Gillibrand.
That's something. I didn't know you could get teenage or adults. You did. Well, I still pretty good.
Mr. Graham. Mr. Grassley. Mrs. Hagan. Mr. Harkin. Mr. Hatch. Mr. Heinrich. Ms. Heitkamp. Mr. Heller. Ms. Hirono. Mr. Hoven. Mr. Inhofe. Mr. Isaacson. Mr. Johans. Mr. Johnson of Wisconsin. Mr. Johnson of South Dakota. Mr. Kane. Mr. King. Mr. Kirk. Ms. Klobuchar. Ms. Landrieu. Mr. Leahy. Mr. Lee. Mr. Levin. Mr. Manchin. Mr. Markey. Mr. McCain. Mrs. McCaskill. Mr. McConnell. Mr. Menendez. Mr. Merkley. Ms. Mikulski. Mr. Moran. Ms. Murkowski. Mr. Murphy. Mrs. Murray. Mr. Nelson. Mr. Paul. Mr. Portman. Mr. Pryor. Mr. Reed of Rhode Island. Mr. Reed of Nevada. Mr. Risch. Mr. Roberts. Mr. Rockefeller. Mr. Rubio. Mr. Sanders. Mr. Schatz. Mr. Schumer. Mr. Scott. Mr. Sessions. Mrs. Shaheen. Mr. Shelby. Ms. Stabenow. Mr. Tester. Mr. Thune. Mr. Toomey. Mr. Udall of Colorado. Mr. Udall of New Mexico. Mr. Vitter. Mr. Warner. Ms. Warren.
Ms. Yellen?
Mr. Whitehouse. Mr. Wicker. Mr. Wyden.
Senators voting in the affirmative: Alexander, Blumenthal, Booker, Brown, Cantwell, Cardin, Casey, Coburn, Donnelly, Flake, Franken, Gillibrand, Hagan, Hirono, Johnson of South Dakota, Kane, Kirk, Leahy, Manchin, Merkley, Mikulski, Nelson, Reed of Rhode Island, Schatz, Tester, Udall of New Mexico, Warner, Wyden. Senators voting in the negative: Barrasso, Blunt, Cochran, Cornyn, Crapo, Cruz, Fisher, Grassley, Isaacson, Johans, Johnson of Wisconsin, Roberts, Scott, Vitter, Wicker.
Ms. Collins, aye. Mr. Toomey, no. Mr. Pryor, aye. Mr. Hoven, no. Mr. Levin, aye. Mr. Carper, aye. Mr. Udall of Colorado, aye. Mr. Bozeman, no. Mr. Lee, no. Mr. Murphy, aye. Mr. Sessions, no. Mr. Rubio, no. Mr. Heller, no. Mr. Menendez, aye. Mr. Corker, aye. Mr. Inhofe, no. Mrs. Feinstein, aye. Mr. Baucus, aye. Ms. Klobuchar, aye. Mr. Enzi, no. Mrs. Boxer, aye. Ms. Murkowski, aye. Mr. Whitehouse, aye.
Mr. Heinrich. Mr. Heinrich. Aye. Mr. Risch. Mr. Risch. No. Mr. Burr. Mr. Burr. Aye. Mr. Chambliss. Mr. Chambliss. Aye. Ms. Ayotte. Ms. Ayotte. Aye. Ms. Landrieu. Ms. Landrieu. Aye. Mr. Coates. Mr. Coates. No. Mr. Coons. Mr. Coons. Aye. Mr. Shelby. Mr. Shelby. No. Mrs. Murray, aye. Mr. Reed of Nevada. Mr. Reed of Nevada. Aye. Mr. Bennett, aye.
Reverse question.
Mr. Coates, aye. Ms. Stabenow, aye. Mr. Rockefeller, aye. Mr. Schumer, aye. Mrs. McCaskill. Mrs. McCaskill, aye.
Other senators wishing to vote or wishing to change their vote? If not, the yeas are 56, the nays are 26. The nomination is confirmed.
Mr. President.
The Majority Leader.
I ask unanimous.
Senate will be in order.
No, I did not.
Senate will be in order.